Tax questions are not hard. The real problem is what to include, what to remove, and which route to follow. In this video, I will teach you gross income, taxable and not taxable income, allowable and non-allowable expenses, capital allowance and loss relief, old and new tax rules, and when to apply them in exams. I will also solve question number 1 of ICAN November 2025, taxation at the skill level. And I will make the video simple. You can revise it in 5 minutes before your exams. What is sole proprietorship? A sole proprietorship is simply you doing business as yourself. When you are doing business yourself, that is sole proprietorship business. That is, it is a one-man business. A business that is owned, managed, and controlled by one person. That is sole proprietorship. So, no separate legal entity is involved. In a sole proprietorship, there is no legal entity. That means your business income is your personal income. In sole proprietorship business, your business income is your personal income. So the government tax you under personal income tax. So the applicable tax rule is Personal Income Tax Act. So government tax you under personal income tax. So what is the basis period for sole proprietorship business? The basis period for assessment is preceding year basis. Preceding year basis, PYB. So that is the basis period. Basis period of assessment of taxation of sole proprietorship is preceding year basis, PYB. So, income eligible for assessment or profit of sole proprietorship. Sole proprietor. The profit or income of a sole proprietor will be divided into two. You know, when we say profit is income minus expenses. So, income minus expenses, that gives us the profit. So, profit equals to income less expenses. By the time you deduct the expenses from the income, you arrive at the profit. So we want to look at the profit eligible for assessment. So this income will be divided into two. The income will be divided into, we have the taxable income and the non-taxable income. Non-taxable income. We have two categories of income. We have the taxable income, we equally have non-taxable income. And expenses, on the other hand, will be divided into two. We have the allowable expenses, and non-allowable expenses. Non-allowable expenses can also be called disallowable expenses. So we are starting with number 1, taxable income. What are taxable income? Taxable income are the income the government will actually tax. The income that will be taxed by government are called taxable income. So taxable income of a sole proprietorship includes the gains or profit from trade or business. Taxable income includes gains or profit from trade or business or profession. If you are running a trade, the profit from your trade or your business, and if you are running a professional firm, So the fee you receive is an income. So the fee, the commission receipt are examples of income from profession. So number 2, we also have the salaries or wages. Salaries or wages, that is if you are in employment. Salaries or wages are examples of income that will be taxed. Number 3, we have bonuses. Bonuses and benefits in kinds. Benefits in kinds. So benefits in kinds, that is the expenses incurred by the employers in providing benefits to the employees. So for instance, where the employee use the official assets of the employers. All these have been explained in my earlier video on personal income tax. Then we have dividends. Dividends, interest, rent. So where you make some investment, you receive dividend from the investment. Where you give out loans, the interest received on loan, that is interest income. Where you have a property which is rented out, the rental income. So they will all be taxed in the hands of the sole proprietor. So having examined the taxable income, number 2, we have non-taxable income. By non-taxable income, we mean the income that will not be taxed. They are not to be taxed. Non-taxable income. They are income that will not be taxed. They are not taxable in the hands of the recipients. Examples include the profit from disposal of property, plant, and equipment. Example of non-taxable income, we have profit from disposal of property, plant, and equipment. Then we also have profits or gains from the disposal of investments. This income will not be taxed in the hands of the sole proprietor. We have examined taxable and non-taxable income. We therefore want to examine allowable expenses. Allowable expenses. What are allowable expenses? Allowable expenses are the expenses which the tax authority permits you, to deduct from your income when calculating your taxable income. The expenses which the tax authority permits you to deduct from your income when calculating the taxable profit. As a golden rule, we have the golden rule. The golden rule for identifying the allowable expenses is when? So the first W in red it stands for wholly. Wholly. By wholly, we mean the expenses must be entirely for the business. That is, all the expenses must be incurred for business purpose. No other purpose other than business. That is, these expenses must not include private or personal expenses. Everything must relate to business. Then the letter W stands for reasonably. By reasonably, we mean the expenses must not be excessive or extravagant. The expenses must not be excessive or extravagant. That is, buying a private jet for a small shop, we know it's not reasonable. How can a small shop, how can you buy a private jet for small shop? That is not reasonable. It must not be excessive or extravagant. So letter E, we have exclusively. Exclusively. By exclusively mean the expenses must be only for business. It must be only for the business, not used for personal use. It must not include personal expenditure, e.g. shop rent is for business, but your personal house rent is not. The shop rent is for business, your personal house rent is not for business. So then we have the letter N, which stands for necessarily. Necessarily. By necessarily, we mean the expenses must be required for the business to operate. The expenses must be required for the business to operate, e.g. transport for delivery. Transport for delivery. So we want to examine the list of allowable expenses. To remember the allowable expenses, just take note of the mnemonic smart cost. Smart cost. So the first letter S stands for salaries and wages. Salaries and wages. Salaries and wages incurred for business purpose is allowable, not your private salary. If you pay salary to yourself, it's not allowable. Then we have motor expenses for business. That is letter M. Motor expenses for business. The motor expenses we incur for business purpose is allowable. So it is incurred in the normal course of business. Letter A stands for advertising. It is normal for business for you to advertise your business so as to increase your sales. The letter R stands for rent of business premises. It is allowable. Rent of business premises. Then we have letter T, which stands for transport and delivery. Transport and delivery. So it is normal for business to incur that. Then letter C stands for communication expenses. Expenses incurred for communication purpose. Communication expenses such as phone, internet for business, they are allowable. Then the letter O stands for office expenses. Office expenses, they are incurred for administrative purpose. Then the letter P stands for professional fees. Letter P, professional fees. Maybe you engage the service of a chartered accountant, a valuer, a surveyor, that whose service relates to business. If they work for you in your business, so the fee you pay them is allowable. Then the letter S stands for stationery. The first S stands for stationery. So the stationery purchase for the business will be treated as a revenue expenditure. The last letter S stands for specific provision for doubtful debts. Specific provision for doubtful debts, or specific allowance for receivables. Specific allowance for receivables. Specific allowance allowance for receivable. Whichever one you see in the question, they mean the same thing. So is allowable. So now, having examined the list of allowable expenses, we want to consider the non-allowable expenses. Number 4, we have non-allowable expenses. Non-allowable expenses. These are expenses not allowed to reduce taxable profit. You are not permitted to reduce the taxable profit by these expenses. They are also called disallowable expenses. Another one for non-allowable expenses is disallowable expenses. I've told you, you are not permitted to reduce your taxable profit by this class of expenses, where these expenses have been charged in the account, where they have been deducted. So you will need to add them back. So now, to remember the non-allowable expenses, I want you to take note of the mnemonic practice gap. Practice gaps. Practice gaps. The first letter P stands for private or domestic expenses. Private or domestic expenses, e.g. personal rent, children's school fees, family medical bills, etc. Personal rent, children's school fees, family medical bills, etc. So they fall under this. Any expenses of private nature are not allowable. The letter R stands for reserves and provisions. Reserves and provisions. Reserves and provisions, e.g. estimated future losses. Research provisions are estimates. So estimated future losses are not allowable. General provisions for doubtful debts. All other provisions apart from specific provision for bad debts. Any provision you see, provision for tax, provision of whatever type, are not allowable. The only provision that is allowable is specific provisions for doubtful debts or specific allowance for receivables. Apart from that, no other provisions is allowable. Letter A. A stands for appropriation. Appropriation of profits. Appropriation of profits. So appropriation means distribution. So distribution of profits, e.g. drawings, transfer from profits to reserves are not allowable. Then the next letter is letter C. C stands for capital expenditure. Capital expenditure. All capital expenditure are not allowable. Acquisition and disposal of tangible non-current assets. So they are not allowable. Any expenditure that will add to the value of the existing asset. Purchase of non-current asset, disposal of non-current asset, any expenditure of capital nature, they are not allowable. The letter T stands for tax and penalty. Tax and penalties. Tax and penalties are not allowable. E.g. income tax, fines from VIO, Federal Road Safety Corps, or penalties for late filings, they are not allowable. Then we have letter I, which stands for improvement. Improvement Improvement and alteration. Improvement and alteration. Improvement and alteration are not allowable. E.g., cost of adding a new floor to your roof. Cost of adding a new floor to your roof. Then the next letter is letter C, which stands for capital loss. Capital. Anytime we have capital, we are referring to assets. Capital loss, such as loss from disposal of tangible non-current assets. Loss from disposal of PPE, they are not allowable. The letter E stands for expenses not within rent principle. Expenses, expenses not rent, expenses not wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating revenue. Then the next letter is letter G, which stands for gifts and donations. G for gifts and donations. Gifts and donations. Donation not specific approved government funds. Any donation that is not among the funds approved by government are not allowable. If it is any donation that is not specifically approved by government, they are not allowable. Then we have letter A. A stands for asset depreciation. Depreciation of an asset, they are not allowable. Asset depreciation are not allowable. It's a non-cash item. Then we have letter P, which is pre-trading expenses. P, pre-trading expenses, such as preliminary expenses. Expenses incurred before the formation of the business, or expenses incurred before the commencement of the business. They are not allowable, such as research expenditure, preliminary expenses. They all fall within this category. Then the last item we want to examine is letter S, which stands for salaries and interest to owners. S, salaries and interest to owners. Owners are not allowed to pay interest to themselves, and neither are they allowed to pay any salary to themselves. All these are not allowable for tax purpose. Core changes brought by the new tax reform. Number one, we have consolidated relief allowance. In the old tax law, we have consolidated relief allowance, which is higher of 1% of gross income, higher of 1% of gross income plus or 200,000 naira, whichever one is higher out of these two, plus 20% of gross income. You choose the higher of these two, then you add 20% of gross income to it. That will give you the consolidated relief allowance. We have that under the old tax law, but it has been abolished under the new tax reform. So this consolidated relief allowance has now been replaced with rent relief relief of 20% of rent or 500,000. The lower of the two. Now replace with rent relief of, we have the lower of, so to calculate the rent relief, we take the lower of these two. 20% of rent or 500,000 naira. Whichever one is the lower will be taken. So if you go for the lower of this, that means the maximum rent relief allowance you can claim will be 500,000 naira. So if you choose the lower of these two, so you use that in place of consolidated relief allowance. Number 2, we have Personal Income Tax Act. Personal Income Tax Act, PITA. The Personal Income Tax Act, PITA, has been replaced or has been repealed. It has been abolished. It has been removed. It has been repealed and replaced by the Nigeria Tax Act, NTA 2025. So this has been replaced by the Nigeria, it is now called Nigeria Tax Act 2025. This NTA, Nigeria Tax Act, NTA 2025. So that is used in place of the Personal Income Tax Act. Number 3, we have eligible deductions. Eligible deductions. These items were called tax exempt items under the old tax regime. It was called tax exempt items or tax exempt deductions. So under the new tax reform, the items are officially classified as eligible deductions instead of being tax exempt. So, and these items include National Housing Funds. 1. National Housing Funds. Contribution made under the National Housing Funds Act. So, it is now among the items that are eligible for deductions. Number 2, National Pension Scheme, NPC, NPS, National Pension Scheme Contributions, NPSC, National Pension Scheme Contribution made under the Pension Reform Act is also eligible. Number 3, we have National Health Insurance Scheme. Contributions to the National Health Scheme is also eligible for deductions. Number 4, we have Life Assurance Premium. Any premium paid by you during the preceding year for insurance on your life or spouse is among the eligible deduction. Then number 5, we have gratuity. It is 100% exempt. It is not eligible deduction, but it is an exempted item. So it is 100% exempt. When to use the new rule in exams? Because your exam question might test the old rule and it might test the new rule. And if you don't know when to use the new rule, you may be applying the new rule when you are supposed to use the old rule or vice versa. So that is why I'm stressing this point now. When do we use the old rule? For assessment year falling due between January 1, 2026 till date, use the new tax reform. For assessment year falling due between January 1, 2026 till date, use the new tax reform. So it means, in taxation we use preceding year basis. And it is not possible you are just entering 2026 and you should not be expecting questions involving the new tax reform in May 2026. Because the financial statement you can be given could be at most December 2025. And if you have December 2025, then you are still expected to use the old rule in 2025 assessment year. In 2025 assessment year, you are still expected to use the old rule. So that is why you should not be expecting the new rule in May 2026 diet. Before you can be expecting the new rule, it could be maybe from 2027, or at most, if they want to test the new rule, maybe by November 2026 diet, maybe you can have the accounting year. So in fact, the best year they can test the new rule will be 2027 year of 2027 diet of ICAN exams. So that is when you should be expecting the new rule. So now I want to give you the format for the computation of the chargeable profit and tax liability before I give you the tax rate. Format. You start with the name of the entity. Let's have Iscariot. Venture. Computation of chargeable profit and tax liabilities for 2027 year of assessment. This is assessment. So you start with the net profit as per account. The net profit you have in the statement of profit or loss. Net profit as per account. You add disallowable expenses. Add disallowable expenses. Reported in account. Reported in accounts. Those ones that have been used in the statement of profit or loss are those ones you need here. If it were not used in the statement of profit or loss, you don't need them. So then you add taxable income not reported. You add taxable income not reported in account. The taxable income not reported in account, so you add it. So from this you less not taxable income reported. Less not taxable income reported in account. By reported in account, I mean used. Those ones used. Those ones used in the statement of profit or loss. That's what I mean by reported in account. So if they were used, so you less that. Then we also deduct allowable expenses. Allowable expenses not used, that is not reported in accounts. Allowable expenses not used in accounts. After you deducted the sum of not taxable income reported in accounts and the one allowable expenses not reported in accounts, after those ones, you arrive at adjusted profit or accessible profit. Adjusted profit or accessible profit. Please, allowable expenses used in the account have been deducted in arriving at the net profit figure you have here. Since they have been deducted, you don't need to deduct them again. I said allowable expenses reported in account, that is allowable expenses used in account, have been deducted when you were preparing the statement of profit or loss before arriving at the net profit figure. You know, the net profit is the gross profit minus expenses. Those expenses that are liable among the expenses that have been deducted have been used. You don't need to deduct them again, because if you deduct them, that means you are charging the expenses twice. Allowable expenses that have been used in the statement of profit or loss, you don't need to deduct them again, because if you deduct them again, that means those expenses were used 2 times. So, and that is wrong. So you arrive at the adjusted profit or accessible profit. After the adjusted profit or accessible profit, you add balancing charge, if any. Balancing charge. You add the balancing charge. You have this as the total. Now less capital allowance, if any. Less capital allowance. The amount that will be claimed. So your balancing allowance could form part of capital allowance. So then you now, after this, you now less eligible deductions. If this were the old tax regime, I would have called these tax exempts. They would have been called tax exempt items. Under the old tax regime, these items were called tax exempt items. And those items include, number 1, we have national pension contribution. National pension contribution. National pension contribution. Then we also have national housing funds. National housing funds contribution. National housing funds contribution. Then we have national health insurance scheme. National health insurance scheme. National health insurance scheme. Then we also have life assurance premium. Life assurance premium. So after all these items you subtract, then your gratuity could be part of it, but I told you the gratuity is tax exempt. So, but compensation for loss of office could be part of it. So after this, you have total income. Total income. If it were old tax regime, this would have been called gross income. Then from the total income, you now less, under the old law, you less consolidated relief allowance. But this format is prepared based on the new tax law. So if you are preparing for the current exams in May 2026, put less CRA, consolidated relief allowance. So, but if you are preparing for future exams outside the year 2026, so you can have less rent relief. Remember, I've told you that the rent relief is lower of 20% of rent, lower of 20% of rent, or 500,000. Lower of 20% of rent, or let me say of rent paid, or 500,000 naira. Lower of the two. So that means the maximum rent relief allowance that can be claimed is 500,000. So, if you deduct this, you arrive at the chargeable income. Chargeable income. It is on this chargeable income that the tax will be calculated. New tax rate. The new personal income tax rate. So, remember, I've told you that the personal income tax have been replaced by Nigeria Tax Act, NTA 2025. So, the new rate, any income between is 0 naira to 800,000 naira. The rate of tax is 0%. For an income between 0 naira to 800,000 naira, the tax rate is 0%. For an income between 800,000 and 1 to 3 million naira, the tax rate is 15%. We have 15% tax rate. For an income between 3 million and 1 to 12 million naira. 12 million naira. The tax rate is 18%. 18%. For an income between 12 million and 1 to 25 million naira. The tax rate is 21%. For an income between 25 million and 1 to 50 million naira. The tax rate is 23%. 23%. And any income above 50 million naira. Above 50 million naira, the tax rate is 25%. This is the new tax rate. I've told you when to use the new tax law. I've told you for an assessment year falling due between January 2026 to date. That is when the new tax law should be used. So now, it means in your exams, you'll be given the rate of the old and the new before they will continue giving you the new rate only in the future. But for the recent exam, for exams that will be coming up recently, maybe 2027, 2028, 2029, you may still be given the old and the new rate in your question paper. All these rates will be provided in your question paper. You are not expected to memorize them. So, but just know when to use this new and when to use the old rate. So, old tax rate. Old tax rate. First, 300,000 naira will be taxed at 7%. Next, 300,000 naira will be taxed at 11%. Then we have next 500,000 naira will be taxed at 15%. Then next 500,000 naira again will be taxed at 19%. Then next 1.6 million will be taxed at 21%. And the next, let's say over 3.2 million. 3.2 million will be taxed at 24%. When you compute your tax, you get total tax liability. Total tax liability. When you compute your tax using the applicable tax rate, you get the total tax liability less withholding tax. Tax already deducted. Or let's just say less withholding tax. Remember, withholding tax are deducted on front investment income. They are deductible at the source. So you now get tax to be paid. So this is the format. So even if you are using the old law or the new law, you are expected to follow this. So the major difference now between the two is that the rate of computation is different. Then the consolidated relief allowance, we have that under the old tax law. We have the rent relief under the new tax law. Then under the old tax law, it is a must you have gross income. But under the new tax law, it's not necessary. So these are some of the differences between the two tax regime. So what is question number 1 of ICAN November 2025? Taxation as what example? Keep watching. Example, ICAN November 2025, taxation. Mr. Ajaoke, who lives in the city of Port Harcourt, runs a small business in the name of Oke and Sons Enterprises. The enterprise commenced business in September 2020. The business is involved in buying and selling as well as the manufacture of locally made spices. In the last 2 years, Mr. Ajaoke has been having challenges with the tax authorities over his tax obligations to the state, especially in the area of his personal income tax. He has approached you as a tax expert to help him ascertain the actual tax liabilities for the current year of assessment in order to enable him have a smooth relationship with the tax authorities. He provided the following information regarding his business for the year ended October 31st, 2023. Amount is in 1,000 naira. We have gross profit of 43 million, less salaries of 6.6 million, administrative expenses of 7,750,000, motor running expenses of 1,250,000, medical expenses of 80,000, donations of 750,000, transport and traveling 900,000, rent and rates of 1.2 million, telephone of 300,000, printing and stationery of 950,000, repairs and maintenance of 4.8 million, interest expenses 1.5 million, bad debts of 70,000, legal expenses of 650,000, entertainment expenses of 890,000, depreciation of factory equipment of 2,640,000, miscellaneous expenses of 1,550,000. The total expenses is 32,590,000. Then we have net profit of 10,410,000. Additional information. 1. The building used for the business also houses Mr. Ajaoke, and 2/3 of rent and rates represents the part of the building used for the business. 2. Entertainment costs included 1/3 of the amount spent for Mr. Ajaoke's private birthday celebration. 3. Legal expenses included 400,000 naira paid to a legal practitioner to defend a sale of the company's product by a representative of the business. Note 4. 15% of the miscellaneous expenses were personal in nature to Mr. Ajaoke. 5. Donations were made to Isogi Community Association. 6. Also included in miscellaneous
expenses was the equipment purchased for the factory worth 600,000 naira.
Note 7. Turnover was understated by 2.7 million naira. Note 8. Bad debts were stated after a recovery of a specific debt of 260,000 naira. Note 10. Repairs and maintenance included reconstruction of the entrance gate of the business premises at a cost of 1.6 million naira. Note 10. 160,000 of the interest expense relates to part of the loan used to settle his personal expenditure. Note 11. Allowable expenses of 770,000 naira omitted from the accounts. Note 12. Mr. Ajauke and other income as follows. We have 2022, 2023, 2024. Amount is in thousand naira. Interest net 75,000. That is 75 million, 74 million, 78 million. Rent net 502 million, 600 million, and 650 million. Dividend gross 240 million, 270 million, and 320 million. Note 13. A qualified capital asset was sold during the period and it resulted in a balancing charge of 1.2 million naira. Note, capital allowance already claimed on the asset at the time of disposal was 900,000 naira. Note 14. The unutilized capital allowance brought forward as agreed with the tax authority was
1,875,000, and the capital allowance for the year under review was agreed at 2.2 million naira.
The medical expenses included 200,000 naira spent on his mom health. Note 6. Mr. Ajauke contributed to a recognized pension fund and has a life assurance policy of himself and his spouse. The details included his first asterisk. Pension contribution for the year was 500,000 naira. The second asterisk, annual life assurance premium paid 1.2 million himself, 1.1 million his wife required. Compute the adjusted profits of the enterprise. B. Compute Mr. Ajauke's income tax liability for the relevant year of assessment. ICAN November 2025. ICAN November 2025. Taxation, question number 1. Now let's have the solution to the question. In the requirement A, you have to compute the adjusted profits of the enterprise. Let's have the solution to the question. Solution. In the requirement A, you have to prepare the adjusted profit. What is the name of the entity? It is a must you put the name of the entity. You were told Mr. Ajauke, who lives in the city of Port Harcourt, runs a small business with the name of OK and Sons Enterprises. The name of the entity is OK and Sons. OK and Sons Enterprise. We have computation of adjusted profit. I've told you it is the examiner that we put relevant year of assessment, but you have to state your year of assessment. Remember, this is taxation of a sole trader. I've told you that the taxation of a sole trader is computed on preceding year basis. So what is the year end of the business? You were told he provided the following information regarding his business for the year ended 31st October 2023. So the year end is 2023. So that means the year of assessment using PYB, that is preceding year basis, have to be 2024. Since the year end of the business is 2023. So you have for 2024 year of assessment. Computation of adjusted profit for 2024 year of assessment. So you also put naira and triple zeros. So the starting point is the profit as per account. How much is the profit that were shown in the statement of profit or loss? So in the statement of profit or loss, you have net profit of 10 million for 10,000. So that is the starting point of your adjusted profit. So you have profit as per account, which is 10 million for 10,000. So we now add back. Now you add back, let me say non-allowable expenses. Non-allowable expenses. What are those expenses that are not allowable for deduction in the face of statement of profit or loss? We have depreciation of factory equipment of 2,640,000. So depreciation of factory equipment, 2,640,000. So aside that, so other expenses we can see on the face of the statement of profit or loss are subject to conditions specified in the note. So before we can conclude that those expenses are not allowable, that will be after we might have gone through the note. So in the face of profit or loss, you have salaries, administrative expenses, motor running expenses, medical expenses, donations, transport and traveling, rest and rates. All other expenses given in the statement of profit or loss are subject to certain conditions. So by the time we go through the note, we will know if any of them are not allowable or not. So you still have telephone, printing and stationery repairs and maintenance, interest expense, bad debt, legal expenses, entertainment expenses. We have disallowed the depreciation miscellaneous expenses. I've told you that all those other expenses are subject to conditions given in the note. So from the note now, we want to read the additional information. Note 1. You were told the building used for business also housed Mr. Aja. Okay. The owner of the business is Aja. Okay. So the building used for the business also housed Mr. Aja. Okay. That shows that Mr. Aja. Okay also used the same building that is used for the business for private purpose. And remember, I told you personal or private expenditure are not allowable. And 2/3 of the rent and rates represent the part of the building used for the business. So 2/3 is used for business. So that means the one used for business are allowable. So the 1/3, the remaining 1/3 are not allowable. How much is the rent of the building? We were given rents and rates of 1.2 million in the statement of profit or loss. So you have rent and rates of 1.2 million. Remember, 2/3 of it is allowable. Since 2/3 of that rent and rates were used for the business, that means the 1/3 that are not used for the business, that are used for private purpose, we are going to disallow that. So we have rent and rates. So, which is private, 1/3 of 1.2 million. So that gives us 400,000. The 400,000 are not allowable. That is based on the information in the note 1. Then note 2 now. You were told that from note 2 that entertainment cost included 1/3. Entertainment cost included 1/3 of the amount spent for Mr. Ajaoke private birthday celebration. So this is also a private or personal expenditure. So of the entertainment cost, you are going to disallow the one that is used for private or personal purpose. How much is entertainment expenses? So it reported in the statement of profit or loss. So you have entertainment expenses of 890,000. So we have entertainment
entertainment expenses. So the amount used for private purpose is 1/3. You were to entertainment notes too that entertainment costs included 1/3 of the amount spent for Mr. Ajaoke private birthday celebration. 1/3 is used for private birthday celebration, and that amounted to 890,000. 890,000. So 1/3 of 890,000, that gives us 297,000. So that 297,000 will be disallowed. Now back to note 3. What do you have in the note 3? So in note 3, you were told legal expenses included 400,000 naira paid to a legal practitioner to defend the sale of the company's product by a representative of the business. So they defend the sale of a product. It is normal for the business to defend their product so that another person will not just intrude into that market. They want to protect their product. So it's an expenses that is incurred within the normal business. It is wholly incurred for business purpose. It is reasonably incurred. It is exclusively and it is necessarily incurred for business purpose. So this is allowable. So we say legal expenses included 400,000. So paid to a legal practitioner to defend the sale of the company's product by representative of the business. I've told you that legal expenses is incurred, that is fall within the WREM principle. I've told you that WREM means wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating revenue. So you defend the company's product. The expenses incurred in defending the product of the company is normal to the business. So it is allowable. Note 4. 15% of the miscellaneous expenses were personal in nature to Mr. Ajaoke. This is also a private expenses, a private expenditure. So 15% of miscellaneous expenses, that is not allowable since it is a private expenditure. So how much is the miscellaneous expenses? So we have miscellaneous expenses. You were told from the note 6 that it also included in miscellaneous expenses was the equipment purchase. Note 4. 15% of the miscellaneous expenses were personal in nature to Mr. Ajaoke. So 15%. How much is miscellaneous expenses? So 1,550,000. 1,550,000. So 15% of that is personal. So 15% of 1,550, that gives us 233. 233. Then after that, note 5. We have note 5. You were told in the note 5 that donations were made to Isogi Community Association. Isogi Community Association. Isogi Community Association is not one of the approved body in which donations can be made. So since that donation is made to unapproved body, so it is not allowable. How much is the donation? How much is the donation? Now go through the statement of profit or loss. You have the donation of 750,000. So donation of 750,000 is not allowed since it was made to Isogi Community Association, and Isogi Community Association is not among the list of the approved body in which donations can be made. So donation of how much is the donation reported in the financial statement? So we have 750,000. Note 6. Also included in miscellaneous expenses was the equipment purchased for the factory worth 600,000. Equipment was purchased Equipment is capital expenditure. So hadn't been the capital allowance have not been computed, this expenditure would have been included in the capital allowance computation. So we say capital expenditure are not allowable. So miscellaneous expenditure, which included the capital expenditure of 600,000. So miscellaneous expenses, at least capital item of 600,000 naira. Note 7. Turnover was understated by 2.7 million naira. Since turnover was so understated, that means the profit reported in the statement of profit or loss is equally understated. If profit is understated, that means we need to increase the profit by adding the amount by which the profit or turnover was understated. Under statement of turnover, that is 2.7 million. That is from note 7. Then we have note 8 now. From note 8, you were told that bad debts were stated after a recovery of specific debt of 260,000. So we have bad debts recovered, which is treated as a taxable income. So since it have not been reported, so we can add that to the profit in order to increase it. So we have bad debts recovered. Bad debts recovered. Bad debts recovered. 260,000. Then note 9. You were told repairs and maintenance. From note 9, we were told repairs and maintenance included reconstruction of the entrance gate of the business premises at a cost of 1.6 million. Entrance gate is a capital item. So this is a capital expenditure. Remember, we said that capital expenditure is not allowable for tax purpose. So since it is a capital in nature, since it is capital in nature, so it will not be allowable for tax purpose. That is repairs and maintenance of 1.6 million naira. Then back to note 10, additional information number 10. So we have 160,000 of interest expense relates to part of the loan used to settle his personal expenditure. Personal expenditure. It shows that this interest expense is personal in nature. It says personal expenditure, and we say personal expenditure are not allowable. We have interest on loans of 160,000 from the note 10. Now, note 11. Allowable expenses of 770,000 naira were omitted from the account. So this is allowable expenses not reported in the account. So that means we are going to deduct it. So what we are considering for now are those items that will be added. Note 12, Mr. Ajaoke, and other income as follows. These are other income, and the other income will be used in an earned income. And what we are computing for now is the adjusted profit. So we don't need items that will be used as an unearned income. So note 13, a qualifying capital asset was sold during the period and it resulted in a balancing charge of 1.2 million. So balancing charge will be used after adjusted profit when you want to compute the total profit upon which tax will be computed or chargeable profit. Capital allowance already claimed on the asset at the time of disposal was 900,000. So capital allowance will be claimed, so we don't need that in the adjusted profit. Then note 14, the unutilized capital allowance brought forward as agreed with the tax authority was 1,875,000. And the capital allowance for the year under review was agreed at 2.2 million. So capital allowance will be claimed as a relief. So we don't need that. We don't need that in the adjusted profit computation. Back to note 15. Note 15. The medical expenses included 200,000 naira spent on his mom's health. So the amount spent on his mom's health is a private expenditure. And I've told you that the personal expenses or private expenditure are not allowed. So we have medical expenses. So 200,000 spent on his mom's health. So note 16. We have Mr. Ajauke contributed to a recognized pension fund and has a life assurance policy on himself and his spouse. The details included pension contribution for the year was 500,000 naira. That is the tax exempt items that will be deducted in the computation of gross income. Then we have annual life assurance premium of 1.2 million, himself of 1.1 million, his wife, his annual life assurance premium 1.2 million, that is for himself, 1.1 million his wife. So that is tax exempt deduction. Requires compute the adjusted profits of the enterprise. So we've considered all the expenses that are not allowable for deduction for tax purpose. So the next thing is to sum up those expenses that are not allowable. So we have 2,640,000, 2,640,000 plus 400,000 plus 297,000 plus 233,000 plus 750,000 plus 600,000 plus 2,700 or 2.7 million plus 260,000 plus 1.6 million plus 160,000 plus 200,000. The total of non-allowable expenses is 9,840,000. 9,840,000. So we now add it to profit as per account of 10 million for 10,000. So we have 20,250,000. 20,250,000. So remember, we have allowable expenses of 770,000 were omitted from the accounts. That is allowable expenses not reported in the account. So allowable expenses not reported in account. So we are going to deduct that. So we less allowable expenses not reported in the account, less allowable expenses. So you were told allowable expenses omitted from the account. So since it was omitted, that means it was not reported. Not reported in accounts. That amounted to 770,000. So if you deduct the 770,000, then we have an adjusted profit of 90,480,000. 90,480,000. That is adjusted profit. That is the solution to A part of the question. In the B part of the question, you are to compute Mr. Ajao's case. Compute Mr. Ajao's case. Income tax liabilities for the relevant year of assessment. We want to compute the income tax liability of Mr. Ajao's for relevant year of assessment. Remember, the year of assessment is 2024. The B part of the question. The name of the entity is OK and Sons Enterprises. You have to compute Mr. Ajao's income tax liability. They have OK and Sons Enterprise. Then you have to compute income tax liabilities. Income tax liabilities. The question says for the relevant year of assessment. So income tax liability for, if you put relevant year of assessment, you've automatically scored 0. So remember to always state the year of assessment. You know, it is PYB. So the year of assessment will be 2024. It is a must you write 2024 year of assessment. If you put relevant year of assessment, you've automatically scored 0. So the starting point is earned income. And income. So the only earned income we have in the question is the profit from the trade or business, which was reported in form of adjusted profit. Adjusted profit. From the solution to the A part of the question, we have the adjusted profit of 19,480,000. That is the adjusted profit from the solution to the A part of the question. If you go through the note 13, you were told that a qualified capital asset was sold during the period and it resulted in a balancing charge of 1.2 million naira. Capital allowance already claimed on the asset at the time of disposal was 900,000. So you have the capital allowance that will be claimed to be 900,000. So the balancing charge of 1.2 million. So we add balancing charge of 1.2 million naira. So if you add 1.2 million to 90 million, 480. So we have 20 million 680,000. 20 million 680,000. So you now want to claim capital allowance. So we now less capital allowance. Then you just say capital allowance, capital allowances. The one for the year. How much is the capital allowance for 2024 year of assessment? So note 14. The unutilized capital allowance brought forward as agreed with the tax authority was 100,875,000. And the capital allowance for the year under review was 2.2 million. So these two capital allowances will be aggregated before capital allowance will be claimed. So the one for the year is 2.2 million. 2.2 million. So capital allowance brought forward. So that is 1,000.875. So if you add that, so the total is 3,200.875. Then we now have capital allowance claimed. So you can claim the capital allowance since it's lower than 2/3 of the assessable profit. So if you claim the capital allowance, so you'll be left with 17,479.125. Then after capital allowance, so I think that is all the earned income we have in the question. So we now want to consider the unearned income. Unearned income. So where any of this, so preceding year basis is still in use. That means the income for 2023 will be assessed in 2024 year of assessment. So now we have interest net. The one for 2023 is 74 million. Rent net 600 million. Dividend gross 270 million. So those ones that are reported net, we make them gross. That means withholding tax of 10% have been deducted at the source. So we have to gross it. So the first one is interest. So interest now. So the gross interest, you are given net to be 74 million. So you divide it by 0.9. Anytime you are given net, if you want to calculate gross, just divide the amount involved by 0.9. 74 million divided by 0.9. So we have 82,222. 82,222,000. So the 0.9 is equivalent of 90%. Withholding tax of 10% has been deducted. So if you deduct 10% from 100%, you'll be left with 90%. If you convert the 90% to decimal, it gives you 0.9. That is how I got 0.9. Just to convert net to gross, divide by 0.9. Please take note of that. The next one is rent. It was reported net. So now let's gross it. So what do we do? The amount is 600 million. So to convert it to gross, divide by 0.9. 600 million divided by 0.9. That is total 666,667,000. 666,667. So the next one is dividend. The dividend has been reported gross. Since it is gross, you don't need to gross it further. So it is already gross. So you were told dividend gross. So the one for 2023, which will be used, is 270 million. So we have 270 million. So if you sum up that 667 plus 270,000 plus 82,222. So we have 1,018,889. Since the amount here is in thousand, this will be 82.222.
This will be 66, or let me just say 82,000. This one will be 67,000. This will be 270,000. So the total of this 82,000 plus 67 plus 270. So we have 1,019. 1019. So if you add that to 17,479.125, so we have 18,498. So I've eliminated 0.125 since I'm rounding up all figures to the nearest thousand. Less franked investment income. Franked investment income, which is the dividend which was reported gross here. So you deduct that. So if you less the 270 from 18,498 minus 270, then you have 18,228. 18,228. From this you less tax exempt items. Tax exempt items. Back to the note. Note 16. You were told Mr. Ajauke contributed to a recognized pension fund and has a life assurance policy on himself and his spouse. The detail include pension contribution for the year was 500,000. So we have pension contribution of 500,000. 500,000. Back to the note. Annual life assurance premium paid 1.2 million himself and 1.1 million his wife. Annual life assurance premium. Life assurance premium. Himself is 1.2 million. His wife is 1.1 million. And that is totaled 2.3 million. So the tax exempt items. So there are no other items. So if you sum up this, you have 2.8 million. If you subtract 2.8 million from 18,228,000, then you have the gross income of 15,428,000. That is the gross income. Gross income. From the gross income, we less consolidated relief allowance, which is higher of 1% of gross income of 15,428,000 or 200,000. So now, what is 1% of this? One percent of this is 154,280. So the 200,000 is greater. So we choose 200,000 naira since it is greater than that. Plus 20% of gross income. 20% of gross income, which is 15,428,000. What is 20% of that? 15,428,000. 20% of that gives us 3,086,000. We have 3,086,000. So the sum of the two, this is 200,000 plus 3,086,000. So the total will be 3,286,000. If you deduct 3,286,000 from 15,428,000, so you'll be left with 12,142,000. 12,142,000. The 12,142,000 is our chargeable income. That means we have the chargeable income of 12,142,000. Chargeable income. It is on this chargeable income that the tax will be paid. So now, if you look at the B part of the question, you have to compute Mr. Ajaoke income tax liability. So compute Mr. Ajaoke's income tax liability for the relevant year of assessment. So we want to compute the income tax liability for the relevant year of assessment. So which is 2024 year of assessment. So the B part now, we have Mr. Aja. Okay. Income tax liability for 2024 year of assessment. So remember the tax table. Since the year of assessment is 2024, the tax table, the old tax table will be used. And we have that one first, 300,000 at 7%. 7% of 300,000, that gives us 21,000. So this 21,000 is greater than, the 12,142,000 is greater than 300,000. Next, 300,000 at 11%. That gives us 33,000. What we have taxed so far is 600,000. Next, 500,000 at the next rate is 15%. So 15% of 500,000, that gives us 75,000. The next 500,000 at the next rate is 19%. 19% of 500,000. That gives us 95,000. So we've taxed 300 plus 300, that is 600, plus 500, that is 1.1, plus 500, that is 1.6. We've taxed 1.6 million so far. And remember, the total income is 12,142,000. That is our total income. So this is our target, 12,142,000. So next, 1.6 million will be taxed at 21%. 1.6 million times 0.21, that gives us 336,000. 336,000. If you sum up all this, what we have taxed so far is 3.2 million. The sum of all this is 3.2 million. And our income is 12,142,000. So then over 3.2 million now. Over balance. Now let me just say balance. You from the income of 12,142,000, you've taxed 3.2 million. Addition of this plus this 600, 1.1, 1.6, 3.2. Balance now. From 12,142,000, minus 3.2 million you have taxed so far at what is the tax rate? Anything above 3.2 million will be taxed at 24%. So we have 12,142,000 minus 3.2 million. That gives us 8,942,000 times 24%. So that will be 2,146,080. So if you now sum up all the tasks computed, we have tax liability 2,146,080 plus 336,000 plus 95,000 plus 75,000 plus 33,000 plus 21,000. Everything is total 2,706,080. 2,706,080. Now from this, you deduct the withholding tax that have been deducted. If you look at interest was reported under or earned income, the interest was reported net and the rent was reported net and we gross it. So the withholding tax that have been deducted from there, you have to deduct it. So less withholding tax. Withholding tax on those income that were reported net. In the question, we have interest. The gross interest is 82,000. The net amount was 74,000. These 74,000 were given in the question, but when we gross it, we got 82,000. So the withholding tax is 82,000 minus 74,000. Then you have 8,000 as the withholding tax. Then rent was reported net. So when we gross it, we got 67,000. 67,000. The net amount was 600,000. So that means with the withholding tax that have been deducted is 67,000. So if you subtract those withholding tax, so what would you have? 2,706,000. 2,706,080 minus 8,000 minus 67,000. So we have 2,631,080. 2,631,080. So that is the net tax payable. So this marks the end of the solution to the question. If you find this video useful, please drop the love emoji, like the video, and also share it with others. Thanks for watching Ezikan.